Great, so our slides are up and live. So welcome to everyone. We're really excited to have you guys here. This is a webinar sponsored by CommonGenius, and I'm gonna break down a little bit what CommonGenius is in 1 minute. And our esteemed speaker today is Regina Leung, who's the Executive Director of Bay Angels in San Francisco, an experienced angel investor with a lot of experience in the healthcare industry. She's also an expert on CommonGenius. So what is CommonGenius and who exactly am I? I'm gonna let you know that. So my name is Samantha Carlin. I'm gonna be moderating this. I am the Director of Global Community and Expert Engagement at CommonGenius. So that means I get to deal with all of you guys, and I love that. I have a background in foreign policy and global gender analysis, and also mentoring social entrepreneurs from around the developing world as the Director of Engagement at Ashoka prior to being at CommonGenius. So what is CommonGenius? So CommonGenius is a platform where you can search for experts on demand and book time with them on video chat. So you can, whether you're building your business or trying to accelerate your career or learn how to become a better manager, we have experts from a variety of industries who have a ton of experience who are waiting for you to ask them for advice. And we are global. So we love the fact that we have people from all over the world who can talk to you, give you advice, help you build a business plan, become a better manager, improve your public speaking, whatever it is that you're trying to do, we have an expert. CommonGenius is new. Our website will be launching in January of 2019, and our iOS app is going to be live within the next 24, 48 hours, and when it's live, we will send out that link. So on CommonGenius, this is an example of a homepage for CommonGenius. Basically, you would go onto our website or our iOS app and search for an expert based on whatever the topic is that you need help with. Like I said, whether it's public speaking or angel investing, etc. And then you can find different experts of various backgrounds and then choose who you're interested in. You can also see their per minute rate to talk to them. And then you can send them you can message them with 3 meeting times of when you're available to speak with them. And then you just book a meeting straight through the site. So that's a little intro on CommonGenius. So now I want to introduce our esteemed speaker who has taken time out of her busy schedule to be here and chat with you guys today because she considers it extremely important and part of her own personal mission as well to educate the leaders of tomorrow. So Regina is the Executive Director of Bay Angels, which is a San Francisco angel investment group. She also has over 25 years of healthcare experience doing advisory services, strategic planning, mergers and acquisitions, due diligence, financial modeling, and product marketing for both startups and Fortune 11 companies. She's been working with some of the biggest consulting firms and pharmaceutical companies such as Bristol Myers Squibb, and PDL Pharma. She knows about startup evaluation, funding support, corporate licensing, partnerships, pre- and post-drug launch support, performance tracking, patient services and patient access, and also knows a lot about IPOs in China, and also about how to do a successful exit and how should you plan for a successful exit in this healthcare industry. She's a board member at Global Healing and the CEO of Mayflower Health, which is her own consulting firm. And she's also an advisor at UC Berkeley's Skydeck Accelerator, which is with a focus on gene and orphan diseases and artificial intelligence drug discovery. She's also an advisor at the University of Southern California Venture Fund. So without further ado, I'm going to give it away to Regina to take the floor. Thanks, Regina.
Great. Yep. Thanks, everyone. Thanks, Samantha. All right, can everybody see the screen? I just want to make sure. I'll be using the following slides in the 45 minutes or so session we have today. And as far as the format, we have about 10 slides, roughly. So I will go through each one of these, kind of some in more greater details. I think taking the pulse, talking with Samantha, there's quite a few founders in the guest attendee list today. So there's one slide that I really want to focus on, is what do angel groups typically look for as far as pitch decks. So I'll spend a bit of time there, and I'll take a few questions intermittently. So that would be the format. But again, thank you so much again for having me at CommonGenius today. Thank you, Samantha, for that introduction. So on this slide, the format of our session will be, I will go into just angel investment overview. What actually is an angel investor by the definition, according to some of the SEC definitions. I'll go into kind of the startup evaluation as conducted by most angel groups, and also specifically talk about. And then my background, as you can kind of see, is mostly in healthcare. So I'm going to go into some of the reasons why we are kind of focusing more on the digital health space, and some of the challenges, pros and cons, obviously, in healthcare, and then open up for Q&A. So with that said, the next slide that I'm going to go into is the definition of what an angel investor is. So this is the Investopia's definition of what an angel investor is. So basically, they define it as a wealthy individual, and that's, you know, that's pretty arbitrary of what wealthy means. But essentially is someone who is interested in investing in a startup early stage company. And for the money in which they invest, in return, they have an exchange for a convertible note or an equity stake within the startup venture. And to be an accredited angel investor, again, according to the society, you have to be earning at least $200,000 a year, or $300,000 combined with your spouse as at a household level. And these numbers needs to be on at least a 2 consecutive years, with expectations that you will continue to earn similarly going forward. If income is not something that you have, the other definition of what an accredited angel investor is, you have to have a net worth of at least $1 million in assets. Now, I think there's some general confusion what this $1 million, because the houses itself, right, in the Bay Area, it's about $1 million. So it does not include $1 million. That $1 million asset does not include your current household, in which your primary residence. So it's your stocks, it's your bonds, right? It could be a real estate investment. It could be a property investment. So it does not include your private residence in which you currently reside. So I just want to kind of point that out. Now, some of you probably have heard that there's a Jobs Act that was recently instilled by the SEC, which does open up. So if startups are now looking for, funding, traditionally you would go to venture capital firms that are investing in early stage companies. You would go to angel investment groups. There is a third platform now, and I think a lot of you folks heard of it. It's the crowdfunding platforms. And according to the new Jobs Act, basically you can fall in an income. If you make less than $100,000, you also, do qualify, which equates to, you can invest up to 2% of your income. If you do make over $100,000 annually in income, you can invest up to 10%. So those are kind of the new definitions. I just kind of want to set kind of the foundation of what an angel investor is. So with that, hopefully no questions there. I'm going to go into the next slide. So I'm going to go through 5 facts. I think there's a lot of questions, right? The first one is, a lot of people out there, at least certainly when I started in this journey of being an angel investor, I do ask, do I actually make money, right? Because we don't know what's going on. So I took here some statistics that I got from the Harvard Angel Investment Group, just to show you, again, there's going to be a lot of variations based on the different angel groups. Some are very well established. So in San Francisco, there's one called the Band of Angels. They are the oldest angel groups in Bay Area. So they have a long track record, and therefore sophistication, right, as well, versus other angel groups, that could be younger and not as structured. But on average, this particular analysis says the internal rate of return for any investments from an angel investor can be anything from 18% to 54% across 12 large studies. So it provides some sort of a range, right, as far as kind of the return on the investments. And this second bullet is very interesting to me because it says 47% of angel investments exited at a loss versus a higher percent at 64% for venture capital investments. So that was, interesting to me because usually you would expect angel, investors come in at a much earlier round. So chances of, failures of companies should be accordingly higher. But this was kind of a flip for me. So that was interesting. Now, I think what you're going to see, the trend right now in the industry is there are more what we call early stage venture funds. Instead of typically investing in just Series A onwards, they are getting more and more upstream, and some are actually as early as seed. They participate in seed rounds. So there are definitely going to be a different kind of trend as we continue in the venture fund kind of landscape. And I expect this ratio of 47 to 64 is going to continue to change and evolve as the landscape continues to change. And then another interesting stat on this slide was angel versus venture funds in terms of what they constitute as a home run are roughly about, and they define this home run as over 100%, roughly equal, which again is very surprising for me because, as I stated earlier, angels tend to take more risk, and obviously their investment gets diluted over time as well because they are coming at such an early stage, an early round. So anyhow, I just want to point some of the statistics out just to level set kind of, do they actually make money? So again, I think if you look at, and I'll come to this later slide, any investments, it's about portfolio diversification, right? So if you hold too many of the same stocks in the same kind of companies, you're not really diversifying your portfolio. So it is the same in angel investments. You typically make, 2 to 3 investments a year, and you try to look at different companies, and you diversify kind of your risk over time by having different types of companies within your portfolio. And we'll go a little bit more in details what this means in a later slide. Okay, is there any questions here? I didn't see any questions. Okay, we're going to go to the next slide. So why be an angel? A lot of folks basically ask, why should I join an angel investment group, right? Why can't I go on my own? So I want to just go through some of the areas why you would want to kind of be involved in an angel group, like the one I am involved with, Bay Angels. So a couple of things that I think out of the gate, it's almost a requirement. You need a large bank account. So, I think traditionally people have looked at investments from an angel investor perspective, 50% will fail. I've actually heard yesterday, went over to the Skydeck demo day. I've heard actually as low as 1 in 20 companies actually succeed for an angel investor. So given this very low ratio of success, right, you need a pretty good sized large bank account to invest as an angel investor. And with that said, given the statistics that I just mentioned, you need a pretty high risk tolerance level because, again, not every single company you invest would come out as a winner. So risk tolerance is very high. And the other thing that I think a lot of people, have myth about is, well, angel investment is pretty fast, right? We can look at a 3-year runway and I can exit with the investments that I made. We found out over the course of the time, typically it takes a company 6 years to exit. Again, there are variations. Obviously, if you go into biotech, right, you are talking about a long runway versus a software platform or marketplace, right? You can exit those relatively easier and a lot shorter. But by and large, on average, it's about 6 years for the companies to exit. Therefore, it's what we call a liquidity event. So let's say you put in $20,000, right, in a convertible note to a startup. And in about 6 years, there's what we call an exit. And it could be acquired, right, by a partnering kind of larger corporation, therefore resulting in what we call a liquidity event. And that is where you can capitalize on your investments. The other thing that is very important is due diligence. I think it's really important from my perspective, a little bit about my investments. My very first one I did, I have to say I didn't do as much due diligence as I should. So it didn't pan out to be a great one. So this is where I think the guiding principle is minimum of 40 hours. Again, an angel group, if let's say there are 2 or 3 angel investors that are interested in that one particular company, to start up that pitch for that pitch event, you can actually leverage your expertise within the group, right? And do a joint due diligence together. And actually, one head, versus 3 heads, 3 heads always win. So I always encourage people, to jointly do due diligence on a company, because there are going to be factors that not everyone, if conducted alone, will be able to capture. So that's some of the pros of joining in an angel investment group. The other area that I think this is a very, this is where we've seen a variation. So the philosophy for me is try to stay within your expertise areas. So for me, I won't necessarily go and invest in something that I don't know a whole lot about, because this actually increases your risk, right? Your risk tolerance. Really understand that could be a lot of nuance. So my own philosophy is always invest in something that you do know. And that way you have a more grounded view into some of the challenges the company will have. And there's one more component to this. Successful companies that I see now, angel groups, or even seed fund, the venture funds that are investing at the seed level, they've created what we call an ecosystem. It's not just the funding part. The funding is already a given, but they create basically a wealth of advisors, right? Active advisors who would actually jump on, besides giving, let's say, $20,000 to a startup company, the advisors actually sit on with the CEO and the founding team members to help them solve problems in an active manner and in a productive manner. So an illustration of this is Skydeck, which I am involved in. So there is a cash infusion. I think it's public. So they give basically $100,000, for instance, as a startup, kind of participant in the Skydeck, and take a certain equity in return. But what comes with that is a wealth of advisors that come in the respective domain, obviously, and expertise for the respective company. So if you are a robotic company, right, so you would want to basically solicit an advisor that has a lot of robotics experience and may even know corporate partnerships that can help you, right, plan your exit strategy as well. So that's becoming a very important component of funding. As a startup, I think, our recommendations, you should be seeking, not just the angels that will give you the check, but looking beyond that is how else can they help you to be successful for longer runway. And this last bullet here is, I mentioned diversification is always key. You don't want to invest in 4 companies or have like AI drug discovery, for instance, right? Because then it increases your risk. So diversification is always key with any investment strategy as a whole, not just isolated to angel investment. I'm going to take a pause here. I don't know if there's any questions. There's one.
Under Q&A.
Yeah.
Publish.
Publish. Got it. So there was a question from the audience asking, what assets do investors actually acquire? Is it a share of the company, and how much if so? So that's a good question. So as an angel investor, you do take equity as you put in money. So I'll just give you an example, right? From my experience. So if you invest in a company, let's say $20,000, right? So there is what we call a term sheet. Typically, the terms in which the CEO or the founder of the company will provide for you. And in the term sheet, it will have some standard terms such as discounts, right? It will also show you the pre-money valuation. So let's say this company is valued at, I'm making this up. Let's say the company is valued at a pre-money of $3 million, and they're looking for $1 million, right? So post-money valuation, we call that a $4 million valuation. So if you, let's say, as an angel, you're putting in, $20,000, you will be given what we call a term sheet. That is how you start the process of engaging as an investor. The term sheets will actually have some standard terms, such as the discount, right? Generally, we're seeing, a 20% discount. And then you're seeing also the valuation involved. And then there are some very technical terms or standard terms in an investment, which spells out, right, there could be a maturity date. So there's basically 3 or 4 forms of investment kind of platforms. One is what we call a safe note. That is pretty standard in the Silicon Valley. And I believe it's either YC or 500 startups have started that utility. Safe note's pretty simple. Most CEOs like it. Then there's another one, which is more standard. It's convertible note. And then the last one, which is the most expensive, which requires a lot of lawyers, engagement and fees. It's called a price round. And the way I ordered these in terms of priority is a price round, as I mentioned, is most complicated, but there's more teeth. So let's say if anything happens to the startup company, the investors are more protected. Versus a safe note is very easy to accomplish, but it doesn't have much teeth. Let's say if something happens to the company. So there's various different aspects. So once you agreed on, let's say, a convertible note, so what it does is it will tell you on the convertible note what is the price per share for that particular round. And if this is a seed round, we actually spelled out, for instance, 10 cents per share. And it will convert your $20,000 investment, right, into kind of what the shares look like. And for convertible notes and price round, there will be actual conversion date spelled out. So these are some level of kind of details. I'm probably going a little bit too much in depth here, but I just wanted to kind of show you the process of how it works. And yes, you will be taking equity share. And in general, angels take a smaller proportion of because the dollar amount is so small, right? So again, this is public. I believe Skydeck gives you $100,000 investment. They take about 5 to 7% equity of your company. So that's generally how it works. Yeah. And then I see another question here. How early is too early? So that's a great question. How much and how early do you need funding? So what I'm seeing in general in the industry now is if you're a startup, you have a really brilliant idea, right, that you want to solve a problem, and we'll come to this a little bit more specifically in a later slide. It is pretty expected now, at least in the Silicon Valley, that you raise the very, very initial, what we call pre-seed money, right, through your friends and family, usually $100,000, $50,000. So that's kind of what we've seen typically now in the angel investment. So once you get the product, right, the product idea obviously up and running. Now you go into what we call a seed round. Now, a seed round is the idea is there, but you may not have a prototype. So now you need seed funding. So this is where you get into kind of what we call a seed round to basically develop a product. And again, the product could be, a software platform. It could be a hardware, which requires a lot more money, right? So it really varies. So I don't have a number. But in terms of, to answer the question, how early is early, this is a word of caution. So again, if you look to raise angel investors' money, they will take your equity, right? So, you kind of have to weigh, right? In terms of timing, you don't want to go too early. The best is get non-dilutive funding. And non-dilutive funding in the world of healthcare is you get a grant, right, from the US government to help with your prototype. So that's another source that you can actually look at in kind of the healthcare space, because NIH, for instance, give a lot of grant funding if this is truly, a product that can help solve problems. So I think I'm going to keep moving here. There's a lot of questions, and I'll come back to those later. All good questions. So as I mentioned earlier, why join an angel investment group? So I think the power of many heads is better than one head. So really that's the most important reason, in my opinion, why you would join an angel group. The other area that I think is really important, and it's the second last bullet on the slide, quality deal flow. So I think this is one thing that I think people don't necessarily appreciate how significant this point is. If you are a very well-known angel investor group, deals are going to come to you because A, you have a brand recognition, and B, the startup founders, right? They have great experience with you as an angel investor group. They actually were able to raise, right, through the organization to continue to build out, their companies to be successful. So the brand recognition of an angel investor group, it's very important. And with that brand comes the quality of the deal flow. So in Silicon Valley, again, as I'm more familiar with, right, companies like YC, Y Combinator, well, they have a great brand. So deal flow is not really, going to be an issue for them, right? And another person that I helped earlier, she is an investor. I do some pro bono work with her in women leadership. She belongs to a venture fund that was in the first round of funding Uber. So again, deal flow like that doesn't matter to them. They have thousands of companies flooding to them. So who you approach, right, is really important, right? And as from an investor perspective, we want the best deal flows, right? The quality companies that will come to you to ensure that the money that you invest in will have a higher chances of success. So I think that's probably the most important reason why joining an angel group is access to great quality companies. And that alone, I think you can't accomplish by yourself, right? Unless you're Peter Thiel and of that caliber. So anyhow, so that's one of the highlights for the slide. So I'm seeing some questions here. I don't know if it's specific to this slide. Yeah, so I have a question here about incorporation before investing. So that's a great question. So the question reads is, how important is it to incorporate the startup before investing? So to actually receive money, you do need to be incorporated. So again, I'm not a lawyer, but just from experiences with dealing with a lot of startups in the past, the recommendation is you should actually be very careful to think about the type of corporate incorporations that you want to be. So should you be a C Corp versus an S Corp? Because there's there's difference, or right, LLC. So in general, again, rule of thumb here, there's no right or wrong answers, but C Corp is the way to go. And you do have to be incorporated to receive money from investors. So there are definitely compliance rules that are out there that you need to go through and incorporate it as a company. There are other factors such as if you have a technology company, right? So when should you start filing patent protection? Again, this is very important. If you have a very unique approach, right, in a software or AI algorithm, it is very important for you to protect your IP. So the sooner you actually think about your IP strategy, right, and to protect it, the better position you're going to be. And usually we start off with what we call a provisional patent application, a PCT. And you can work with, there are law firms out there that you can work with that can do a sliding scale because you're an early stage startup. They don't, gouge you, right? They have a sliding scale type fee structure. So I encourage you to kind of start looking at those as well. Let's see. I'm just checking time here. So I'm going to spend a lot of time on this next slide here. This to me is kind of the main focus of the presentation. So people ask, right, when we go pitch an angel group, right, an angel investment group or angel investors, right, what should I look out for? So in conversing with a lot of the angel groups in the Silicon Valley, these are at a high level what we call must-have requirements. Now, there are going to be variation because every angel group has its own unique style. Some are much more structured. Like I mentioned, Bay of Angels, they're very structured in how they process, right, pitches and startup companies through the pitching screening process, and others are less structured. And then you also have to think about some angel groups I know specifically that are in the Bay Area. They do not take startups that are outside. If you are located in Arizona, they will not take you. So you have to be very crystal clear about these angel groups in terms of what they look for and who they invest. So I'm going to go bullet by bullet and spend quite a bit of time on this slide to explain and take any questions after that. So market size, right? Why is it important? Well, if it's a product that you have created for a company that solves only a $50 million market size, the angel investment group is not going to be as interested as with you as somebody who's going after $1 billion market. So market size is really critical when we think about a product solution or the focus of the company, where they want to go. So something that's right off the bat, that's the first thing that people look for, right? How big is the market size? As a general rule of thumb, anything 10 million, 20 million, 50 million, it's really small by definition. So anything kind of 500 million and above is very attractive for angel groups, right? Because then it's a very sizable market. And then the next 2 points are very tied together. So you'll be amazed. I've come across some companies where the CEO is very passionate because of an event that happened in the family. So they are very motivated to creating a product to solve that solution. But in a lot of the cases, the product in which they try to develop really isn't solving a problem. It's a nice to have. So the first question that we would like to see in a pitch deck is, what is the problem? State early on in the pitch slides, right? What problem are you trying to solve? And what is your product or solution platform, right? What are you trying to solve in terms of the solution in which you provide? And state that very crystal clear up front. And that's very important in terms of the flow. The next one is then, is the product and the solution scalable? So one of the things, right, and this may be more not so critical for angel rounds, but as you go into Series A and Series B, one of the first things, right, they talk about is how scalable your solution from a manufacturing standpoint. And in some of the companies I'm helping right now that are in diagnostics, for instance, right? It is all about productionizing their solution. So do you have, right, the clinical expertise and the manufacturing expertise to scale those solutions in a way that is a very cost-effective manner? So those are some of the things that we'd like to see. Is it scalable? Because obviously anything that is custom tailored, right, it's hard to scale. So we always look for that sort of level of details. The next question is, what is the track record of founders? So I think a lot of this now is becoming more and more critical. Money definitely is out there. The size of each check we found is greater and larger for each of the rounds, but increasingly with what that means is people are looking for track record of founders. So if you are a founder or CEO, right, of a new startup, and you've had, let's say, multiple exits, like in your prior entrepreneurial life, you have a greater chance of succeeding, right, in raising the seed fund because you've already proven a track record and you have demonstrated to investors, right, you can build a company and scale it and actually sell it. So that is one of those unspoken rules. It is not to say that if you're not a serial entrepreneur, you won't get funding. But there's definitely some system bias within the investor community, just something that you should be aware. It is not the be-all, the end-all, but it is a factor in the decision-making process for angel investors. The other one is more tied to Silicon Valley. I think there's quite a bit of criticism in the Silicon Valley. Companies that are started here, they have very high valuation, unlike the rest of the country. So if you are an Ohio-based startup, or even Texas, right, in Houston, for doing the same thing, the valuation of the same company, right, the valuation of that company in Silicon Valley may be higher than that of like in Houston. So again, something to be mindful. The other thing that is very important is, does your product fit into what we call an investment thesis for that angel group? So an investment thesis is typically what defines an angel group, what they invest. So for Bay Angels, for instance, we shy away from anything that's hardware, right? Because hardware is very hard to scale. It's very expensive. So it has a lot more capital intensive requirements. So Bay Angels, we basically don't look at anything that's hardware driven. We like SaaS platforms, we like software platforms, digital health, right, all that, because you can scale. Anything in the cloud, it's very easy to scale. So that's another criteria you need to look for is, does it actually fit, right, the angel group's, kind of focus area or investment thesis. Then moving along to the next one, is your IP protected and is it defensible? So again, I think there's growing interest, right? And you've all heard this through media. I'm currently helping a AI-driven drug discovery company, and there's a lot of interest from China investors, right, to invest in AI, and certainly in the drug discovery arena. So the first question, right, I asked the CEO is, have you filed the IP, right, for your technology, and how defensible is it? And so these are some of the solutions that you'll have to kind of figure out, but this is a must-have, right? If your IP cannot be patented and it's not protected, that is a very big risk for any investors, and you'll see that is a must-have requirement in your pitch deck. So the next one is about the valuation again. Again, we look at, in Bay Angels, we look at anything that's in the less than $1 million kind of money ask. And generally the valuation is in the $3 million range. So for every million that, right, we jointly, bring to the table, we don't look for companies that are greater than 3 million in valuation. So those are the, again, general rule of thumb. You have to understand that. And it does vary from angel group to angel group as well. Traction, we kind of went over that a little bit. Traction here is not so much traction of the founder, but it's traction in terms of revenue. So if you're a SaaS platform, right, what increasingly we're looking for from an investor's point of view is, do you have some paid customers, right, today? Because it demonstrates the value of your company and the value of your product. And the fact that somebody is actually paying for it, right, means that it's a viable business. So traction is something that we'd like to see. And it's definitely, I think increasingly an ask from most angel investment groups. And then the last one is one of those unspoken ones where we basically also look as the team come to present, do they get along, right? Because if it's the CEO that just dominates the conversation, that's just definitely a red flag for us. It should be a team kind of, presentation where people, have great respect for each other and actually work well together. So again, this is, one of those unspoken kind of things that we look for as well. So with that, I'm going to go into Q&A. So there's a question here. So there was a question is, if you don't have a proven track record as a founder, right, what would possible investors look for, and how do you show that? So that's a great question. That's a hard one, right? Because, you can't make up experiences that you don't have. So I think, right, then, to your product, it's a viable one. I think you can bypass this, right, kind of track record point that I just brought out, and and still kind of be able to convince your investors, and I think some of the, again, unspoken rules to share with you, and I've heard this many a times, right, from a lot of angel investors as well as early stage venture funds. When they invest, one of the biggest criteria is, do they actually believe in the CEO and the founder? And what sort of human interactions, right? Is it a good one? Is it lukewarm? And you will find, and this has not, I don't think I've seen any publications on it. It is very important that the angel investor or the VC really truly get along with the CEO and really believes in the company. And generally that's when once they feel comfortable, they do invest. So I just want to caution the companies that's out there. It is really critical to demonstrate integrity, trustworthiness, all the human characteristics, right? And a proven kind of, honesty. And I think with that, you would attract the right investors, shy of a track record type, performance. And it's back to the basics of, right, as human beings, we like to do business with people we like. So it is the same in investment. So don't be shy to just step up and prove yourself, right? And show them who you are. Someone with high integrity, someone with passion, someone truly wants to build a solution to solve a problem. And don't be shy about that as well. And then moving along to the next slide here. So I want to kind of end the presentation with digital health and medtech. So at Bay Angels, we look at digital health. We look at a lot of medical technology companies. And this is a slide to show you, I took this out of the Silicon Valley Bank most recent report, 2018, in terms of why there is a growing interest in digital health. And obviously, this is something near and dear to me. I look at a lot of the technologies out there. So you will see now, right, this is kind of a market analysis where they looked at, right, the percentage of patients that are engaged versus not engaged. So engaged patients are from a payer and an insurance perspective, those are the patients you want to really have as your member lives. And engaged is really someone who takes care of their health, eats right, watches their diet, and exercise regularly. So a lot of the technologies out there are around patient engagement. The consumer health is really important now as a growing kind of a marketplace because of the need for these engaged patients to be monitoring, right, how well they're doing, right? How many calories are they eating per day? For instance, right? They would have an app, for instance. I actually know a good friend of mine. She was trying to lose some weight, and she's, in her 60s, and so it's harder, right, as you get older. She literally has an app on her phone that tells her, right, she's only allowed 2,000 calories per day. So for every food intake, it actually counts how many calories she's taken. So she knows by the end of the day, if she wants a nice piece of pie, right, is she actually going to be allowed that? So it's tools like that that helps, right? And I think it really does work. So increasingly on the corporation side, a lot of the Blue Shields of California, the Aetnas, right? I come from McKesson, and so there are a lot of venture funds now in the corporate world where they're looking for digital health technologies to help them manage the member lives a lot better, right? So you will see now Aetna now actually has a venture fund. Well, they look at digital health technologies that they can help, right? They can invest to help their insured patient population to manage their medical needs a lot better. So I think there is going to be a big consumer growth in the digital health space, and that's why we continue to focus on it. And the next slide shows you how crowded the companies are. And with that, I'm going to end with a recent consulting project that I did, where we interviewed the prior Health and Human Services heads, and in the interview with her on this project, basically, she has confirmed that the consumer health is here to stay, and consumers are now getting a bigger and bigger voice of owning their health, right? And so all these digital health applications, right, wearable technologies, monitoring devices, right, they are going to be ever so important. And so I really believe in the space, and that's why I continue to look at, interesting companies that fits kind of that need. With that, I think that's the end of my presentation. I'm going to probably take one more question here. Oops. So there's a question here. What's the opinion on end consumer versus enterprise space for startups client base? So I'm going to share a statistic with you. I subscribe to a publication called CB Insights, and they do have very interesting startup statistics. So they did a survey where digital health companies that are traditionally what we call B2C, in 3 years horizon from the day they started the company, about 70% would switch from a B2C to a B2B type customer base. And the reasons are numerous, right? But I think in my experience, a B2C consumer is great because, right, you bypass a lot of the insurance issues and reimbursement. But for a company to grow sustainably, B2C is hard because consumers, right, like for instance myself, right, I'm fickle, right? One day I decide I want to buy an Apple Watch. Well, I may not want to wear it anymore. So in 3 years' time, I may not want to invest in an upgrade, right? So the fickleness of the consumer behavior is very hard. So that's why, according to the CB Insights, 70% of startup companies would pivot to more of a B2B type client base to continue to grow the company sustainably. So hopefully that gives you an insight into the significance of a B2C versus a B2B platform, and in terms of the client base that you should consider seeking as your company continues to grow. So with that, I'm going to wrap up. That's my last comment. So with that, I'll turn it back to you, Samantha.
Incredibly informative for me as well. So I hope everybody enjoyed this. We are going to do a Q&A, but I just wanted to go through a couple housekeeping items first. So first of all, the main thing is that the people who are attending this webinar now have access to 50% off of their first one-on-one with Regina on CommonGenius. It's a per minute model, and the shortest number of minutes you can book is 30 minutes. So in order to be eligible for this though, you need to PM Lucy now with your name, email, and phone number. And by the way to PM is you go to chat, and then you click on chat, and then you go to private. And then it says to start a one-on-one chat, click a person's name below, and you'll see the admin. So you want to click on Lucy Sue's name and PM her with your name, your email, and your phone number in order to be eligible for this. Or you can email her at lucy@commongenius.com with your name, email, and phone number within 1 hour of this webinar. So this is a limited time offer. 50% is a lot. So if we don't get to all your questions, which I'm sure we won't, you can book a one-on-one meeting with her. And as you can see, she's an unbelievable treasure trove of information when it comes to angel investing, and can probably save a lot of you a lot of heartache and mistakes and confusion when you're looking at taking on angel investors. For those of you who came in a little bit late, I just wanted to debrief again briefly what is CommonGenius. So CommonGenius is a new platform, and it gives you on-demand access to experts via video chat. So whether you're looking to build a business, become a better manager, a better public speaker, you can search for experts and then book a meeting with them on the platform and then actually talk to them on video through the platform. As I mentioned, we're launching our website in January of 2019, and our iOS app will be done within the next 24 to 48 hours. And when it's done, you'll email it out, and it is very beautiful, and we hope that you're gonna love it. Also, I wanted, for those of you who do have expertise akin to Regina's and you're interested in potentially becoming an expert, that's the link where you can, I think you can't click on it, but if you copy and paste that into your browser, that will enable you to fill out a form to try to get early access to becoming an expert for when we do start accepting new experts into the platform. So without further ado, I'd like to really thank Regina, and I want to turn it back over to her for Q&A. She's going to take another couple of questions. We would like to finish on time, and then again, if you have more questions for her that don't get answered, you can book a one-on-one meeting with her. So Regina, with that, I'm going to turn it back over to you for more Q&A.
Yep, sure. Okay, so I'm looking at some other additional questions here. So I think the one question here is, how do you evaluate what city and state you need to be affiliated with? So there's no right or wrong answers, right? So I mentioned earlier that generally, again, general speaking, companies that are located in the Silicon Valley are priced, the valuation is priced a little higher. So if you are someone that's seeking obviously value, right, as an investor, you may not be looking at Silicon Valley startups. You would look at more middle America, right? Places that are more, you know, kind of middle of the country, Texas, for instance, right? Maybe, you know, kind of Illinois. And increasingly, there are a lot of angel groups now really scattered all United States. And so, you know, as you scout for companies, right, it really depends on where those startups are located. And you will find in general, not just Silicon Valley, but companies that are bi-coastal, right, located like in New England, kind of New York, Boston. I think they're going to have similar, you know, kind of issues with higher valuation than others. So hopefully that answers the question. So again, I think there was a question about in terms of angels, what's the size they would ask, they would give, sorry. So angels do vary in terms of their check sizes, and also the types of angel groups as well. So angel typically would invest anything from 10,000 per company to could be as high as 50,000, right? So if you have it, if let's say you're successful in pitching to an angel group and you have 3 angels, right, that come together and basically said, we're very interested at the $50,000 per check, right? Now, all of a sudden you can raise 150 pretty quickly. So it does vary, you know, on really the types of angel groups. And the one that I mentioned, Band of Angels, they have a very structured way of looking at companies. I would say even more structured than Bay Angels, in which I'm affiliated. So with Bay Angels, let me kind of go through how we deal with companies to invite them to pitch. So usually it starts with a referral. So we'd like to have one of the angel investors within the group bring the company to the screening committee, and is headed by our managing partner, Jordan. So we would have done a little bit of our homework where we would have spoken with the company, or at least, you know, read through some of the slides on the pitch deck. We may have already have a 40-minute discussion with the CEO or the founding team. Then if we feel it's a fit for Bay Angels, right, then we basically recommend it to a screening committee to proceed with the screening process. And what does that mean? So generally we would schedule a half hour upfront for the founder to talk with the screening team. And we would ask a lot of in-depth questions. And if it continues to be a good fit, then we basically do one more deep dive with the company. And basically now we help them, let's say the market sizing is not very conclusive. Maybe we can help, right, in getting the slides in a ready manner for the pitch night. And so generally speaking, we have 1 pitch night per month, and that's pretty standard for most angel groups. And it's about a 7 minutes pitch with a 5-minute Q&A. So your slide deck should really not be very long. It should be no more than 10 slides. And it should have the ingredients that I talked about earlier in that one slide, the 10 things which we're looking for. And then you just effectively, in a concise manner, go through the slides and explain, and then you have a 5-minute Q&A at the end. And then if there's any interest that arises from the pitch night, then we basically would do a regroup with the angels and then schedule a call, either individually with the angels, with the CEO, or it could be as a group in a coordinated fashion. So that's generally how it works. And it is somewhat similar to other angel groups. Some of the other ones that are out there, I belong to another one called Life Science Angels. They have a much more formal event where actually it's a catered dinner. So it does vary, right, across the board. But that's generally how these pitch nights work. I think we're up to the hour. I just want to be respectful of everyone's time. Shall I wrap up? Okay, great. Shall I give it back to Samantha?
Yeah, give it back to Samantha.
All right, Samantha, I think I'm good. Thank you so much for the opportunity to share my insights, and thank you for everybody joining this call.
A big thank you to everyone who attended. We hope that you got a lot out of this. Feel free, there's my email address, so feel free if you have any more comments or you want to share anything about this or have any questions about CommonGenius, feel free to just shoot me an email. As I said, I'm the Director of Global Community. Also, we have 2 upcoming webinars, maybe 3. I should have listed them here, but I didn't. But the 2 coming up, there'll be one on December 5th at 1 p.m. PST, 4 p.m. EST on how to manage like a boss, and that is by Vikas Bhatia, the Director of Prana Partners. And then we also have one coming up on December 12th, which is about UI, so user interfaces. And that is going to be about chatbots and how to know whether or not you should have a chatbot in your product. And that will be hosted by Stacy Saronic, another CommonGenius expert, also at 1 p.m. PST on December 12th. As I mentioned, we will be sending out a reminder to you guys so that you can register. And again, a big thank you. And remember, you have 60 minutes from right now to email Lucy at commongenius.com with your name, your email, and your phone number if you're interested in booking a one-on-one meeting with Regina. This does not put you into a contract that you have to book a meeting, but it will enable you to be eligible for the offer and for us to reach out to you when the app is up so that we can help you to figure out whether you want to arrange that meeting. So usually if I was at a conference, I would give a round of applause. We can't hear anyone, so I'm going to do this for everyone. Regina, that was wonderful and super informative. And thank you for being a CommonGenius expert. Thanks, everybody.